All right, everybody. Thanks for hopping on. It is now 9 p.m. Eastern time, so we'll go ahead and get started here. As I'm working through your questions, I'm just going to be going from top to bottom here in the chat window, so I'll work through them one at a time. And if at any point, if I'm explaining it a way that doesn't make any sense, or you have follow-up questions like that, just throw them in the chat, and I'll get to them eventually here as we work down. We'll be wrapping up in 1 hour, so it is just a 1 hour session here, and we'll be done at 10 p.m. So again, thank you guys for hopping on, and really appreciate the questions you've preloaded here. Looks like we're going to have some good discussions here today. So first question we hear, do you think the dollar will remain the world currency during the next 3 to 5 years? That's a long time frame. If I had to guess, I would say no. Now, there's a difference between will the dollar remain the world currency as it exists today versus in name only. It's very possible that it's still the in name the U.S. dollar, but just not controlled strictly by the Federal Reserve, by the United States government. If the let's say the Federal Reserve does some sort of coordination with the IMF, with the World Bank, and allows a little bit more not intervention, but input on the monetary policies, because essentially the problem with pure fiat, all floating currencies, is that if it comes down to it, every nation is going to do what's in their best interest versus the best interest of another nation. And over the last 5 years specifically, we've seen the entire world, pretty much every central bank that has been doing whatever they can to move away from being completely dependent on the dollar. And so 3 to 5 years, I would say no. The system's not going to look the way that it does today. There's been developments last year. I think it was around July or August, maybe it was later in like September. There were a few countries that had been working on a new system called INSTEX, and I can't remember what that acronym stands for. It's INSTEX, and that it's basically it's like SWIFT. So when you send a wire, when you move money from one place to another, it goes through the SWIFT. And so that's the dollar transfer system that the entire world uses. And so they developed a new payment system that gets around SWIFT, doesn't have to go through SWIFT. And the ability with that system is to get around U.S. sanctions, because that's all sanctions are. It's locking a country out of using the dollar when they don't play by America's rules. And so that's one thing that other countries have done. A lot of European countries and Asian countries were involved in that, and that plus the fact that central banks have been net sellers of U.S. Treasuries for years and buyers of gold. Those all things are put together to look like the world has been prepping for some sort of crisis like this that's starting to unfold right now, so that they don't have to bite the bullet and bail out the U.S. by swallowing all the inflation that we're going to have to create here, and so that they can kind of rebuild in a different way. They're not reliant on the policies of just the Fed and the United States government. So no, I don't think it will. 3 to 5 years, at least not the way it looks today. How long, in my opinion, before hyperinflation sets in, assuming additional stimulus, Fed balance sheet expansion? It's a pretty safe assumption, with the Federal Reserve saying open-ended QE. They're going to do anything they can and anything they have to keep the credit bubble from deflating. Which all that means is that any debt that would have been, before this started to pop on February 19th, this debt was valued right here. Really, these companies were insolvent. They're just surviving based off of that bad debt. And so the market in a credit crisis starts to unload that debt and sell it and sell it and sell it. And there's less and less buyers at those prices. And so the price of that debt starts to collapse. So what the Fed is doing is stepping in and saying, no, we're going to come in there. We're going to be the buyer since we don't care. We don't have to, make a profit, or, they just print money create money out of thin air. They come in and they buy that debt at the inflated prices so that it doesn't hurt the balance sheets of the companies that were holding that debt. And so that's a pretty safe assumption that the Federal Reserve, the additional stimulus from the government, and the Fed's balance sheet continues to go up. So how long until that monetary expansion, which is inflation in the classical sense of the word inflation, results in price inflation? There's two ways that that's going to show up. The first way is it's going to show up without showing up in the official numbers first. It's a godsend right now to the official numbers that what Saudi Arabia and Russia are doing right now with oil, and with travel. Obviously, that has a huge impact on it as well, with travel collapsing right now. So things like that are the prices plummeting in certain areas is a godsend for the official inflation numbers, because that will allow the things that right now most people actually care about. Most people actually have to buy, like food and healthcare expenses. Those can go up, and it won't show up in the official inflation numbers as an overall inflation. And so that's the first way we're seeing it. It's happening already. When you have a supply crunch, which we do right now, we have a huge supply crunch on most things, met with a demand surge. And some of that has to do with, the prepping and the food hoarding a little bit. But the most demand for daily needs it's not going away. It's just the excess and the wants that are going away. So we're having at least the same demand on a lot of things that people need, and potentially more demand with a supply crunch. So we're already seeing prices go up in areas like that. Now, how long before we see this look like hyperinflation? That's a really good question. I mean, my speculation would be it will be extremely noticeable to almost everyone by the end of the year. It doesn't look like they're going to be able to keep a lid on these sort of things for right now. And so for the time being, it looks like somewhere close to the end of the year. Now, these things always take a lot longer to unfold than it seems like they should. For anybody who's seeing what's going on behind the curtain, it takes a lot longer for everybody else to realize what's happening. And so I could be off on that. My prediction for the last year on when the crisis was going to start to unfold was after the election. But the coronavirus kind of pushed it up closer here. So that's my bet, is by the end of this year, we'll start to see, at least with goods and services, a lot of the prices start to go up. And some of the causes from that are going to be, right now the world is dumping treasuries like we haven't seen ever. And that's why the Federal Reserve has had to open. Just today, they opened up another restriction, loosened another policy with banks, their capital requirements. They are allowed to now exclude treasuries from their leverage requirements. And so they're trying to do everything they can to get everybody from getting rid of treasuries, but everybody else in the world is doing it. And so they're opening up all of these, facilities and programs to be able to swap dollars for treasuries. And what is the world going to do with dollars when they are getting rid of treasuries? Treasuries are just dollars that pay you interest. And so when you don't want treasuries anymore, are you going to want to hoard dollars? No, the reason you need dollars is so that you can spend them. And when every single country and central bank is trying to get rid of treasuries, and then they get dollars, and now they're trying to get rid of dollars, the final destination for all those dollars is going to be the United States of America. And that's going to hit assets. It's going to hit goods and services, because we don't produce anything. So a lot of the world is going to be buying back a lot of the stuff that they basically seller financed us to us in the first place, which is something Peter Schiff likes to say. So that's my bet. By the end of the year, could be a little bit longer. What strike price and expiration date would you recommend on GLD calls? There's two parts to this. I'm extremely skeptical of the safety with with gold ETFs right now specifically. This is relatively new because I've just been doing a little bit more research on what's been happening with the futures markets and with the bullion banks recently. And over the past couple of weeks, it looks like the paper market for gold is starting to implode. Now, I know GLD in their prospectus, they say that they have physical gold in allocated accounts. They say they don't have any in unallocated accounts. It's all allocated, which is good. That means they actually have their name on actual physical pieces of gold. But their custodian is HSBC, and HSBC is not it's not the horse that I'd want to bet on winning the race right now in terms of global banks. And they've got huge exposure in Asian real estate markets, specifically Hong Kong, and they've been getting hammered there even before the coronavirus when all the protests were happening. They've had mass layoffs, and so they are extremely stressed as a banking institution. And there's a layer of counterparty risk there. That's the first layer. The second layer of counterparty risk is in London, and London over the last week or two has been extremely loud in trying to tell everybody that they have a lot of gold. And the only reason that's why is the FDIC making videos saying don't pull your cash out of the bank right now because there's enough cash in the bank? Well, if there's enough cash in the bank, why are you telling us not to pull it out? It almost communicates the very fact that you're having to say all of this means that somebody's panicking and somebody's worried that people are going to start trying to collect on this physical gold. And the numbers that they're putting out as far as how many tons of gold they have in their vaults include central bank gold, monetary gold, which is they can't touch that. They can't ship that out. That's somebody else's gold. It also includes ETF gold. And so when you consider, and the third thing is that HSBC stores their gold in London vaults. And so GLD I'm most familiar with because I've read through their prospectus. I know there's others like SGOL and PHYS that I believe both of those say that you can request physical delivery if you have a large enough amount of shares. But when if you don't have it, you don't have it. There's so many layers of counterparty risk there. So when you ask what strike price on calls would I recommend? So first, the other thing is none of this is advice, and I appreciate everybody being on here, and everybody who's followed my channel for any amount of time knows that I'm not actually giving specific individual investment advice or recommendations. It's meant for education purposes only. That being said, a speculative play on gold, buying calls on GLD, is perfectly acceptable. The further out, in my opinion, the better, because you're going to get more bang for your buck in terms of the time value. It's when you look at how much time you're paying for if you buy a monthly option, you're going to be paying 2 to 3 to 4 to 5 times as much for just the time value of that contract than if you go out to a further date that's like a year and a half, or 2 years out. And I don't know the furthest one out for GLD right now. I believe it's June of 2022 or January of 2022. So they're pretty far out there. And then in terms of which strike to buy, the lower the strike, the less risk you're going to have, right? Because then if the price of gold goes down, or if GLD doesn't actually have as much gold as they say they do, you're buying intrinsic value that's already there in terms of the share price. And so if you buy something that's like, on GLD, if you buy like the 70 strike right now, you're probably getting a delta of, probably close to 0.8, which if you're not familiar with options, delta just means how much will that option contract increase by its value for every dollar move in the stock or the ETF that it follows. So if you want you want the delta to be as high as possible, because then you're getting more bang for your buck for each dollar movement. And so if you pay half the price, you're buying a 70 strike call, whereas the price of GLD is 150 right now, you're probably going to be paying like 90 or $100 for that contract. I haven't looked at the numbers. I'm just guessing here. And so you're going to have probably $20 of time value, and the other, $50 of that is going to be intrinsic value, just value that's there. That if gold doesn't move or GLD doesn't move, your value is going to stay there. So you're just going to lose it. That time value will bleed out. And so the lower you can go, the safer that bet. But the higher you go, the better your risk to reward ratio. So if it's a safety move, don't buy GLD and don't buy calls on GLD. That's not a safe play. If it's a speculative move and you're speculating on the price of gold doubling in the next 2 years, buy a 200 strike price option on GLD for 2 years out. And that's going to give you a lot of leverage by the time gold doubles, as long as there's no deceit or counterparty risk that actually comes to fruition with GLD. Then you're going to make a really nice amount of money on those calls. Next question. Do I think silver will continue to go down in price as the wider bear market continues? I don't know. So this is one of the reasons why I've always said that gold is very different than silver, and silver used to be a monetary metal a lot more than it is today. The reason that silver is less of a monetary metal today than it used to be is, number one, because of the digital age. Back in the past, it was, you have a gold coin, that's, in today's dollars worth, $1,500, $1,600. So you're not going to go buy groceries with that because you're going to need to have a way to make change for that. And so silver was valued at has less value per ounce. And so it's the same thing as, like, you're not going to buy your groceries with, maybe today you will, with $100 bills, but with $500 or $1,000 bills, you're going to use smaller bills or change to make those smaller transactions. And so that was what silver was used for. It was still valuable per ounce, but not near as much as gold. So it was used to make change for gold. And that's no longer necessary with the digital age. We have there are plenty of platforms out there where you can store gold and do transactions in fractional amounts of gold with. GlintPay.com. The app is called Glint, Glint. That's an example of, you load it up with dollars, you purchase gold inside the app, and then they send you a debit card, and then you preload that debit card by selling some of the gold into dollars, and then you can spend that debit card. It has nothing to do with the price per ounce. I mean, you don't have to do it in full ounce amounts. And so silver's monetary usefulness is nowhere near what it used to be. Second, its industrial usefulness is a lot more than it used to be. It's used in a lot more electronics and for medical instruments. And so the price is a lot more influenced by industrial uses than monetary uses today, which is, gold is not as heavily used in things like that. Third, silver is more destructible or easily destroyed than gold is. And so there's a more of a need to continue producing it versus gold. Gold is virtually indestructible. So do I think silver is going to continue to go down? It could. Do I think it's inevitably going to go up at some point? Yeah. I just don't think that we should put much weight in, like, for instance, the gold to silver ratio, the historical gold to silver ratio. And it just doesn't have the same monetary qualities that it did in the past. And a lot of that was due to just enforced by law. That people used silver as money because it was the legal money. It wasn't, necessarily the actual free market choice of money. So short term, yeah, could go down. I think it'll eventually go up because I think the price of everything in US dollars will go up. Live in Canada, savings and wage in Canada have gone down about 40% against the dollar. Gold coin costs about 2,400 in Canadian dollars. So it versus how much the Canadian dollar has depreciated, would I still recommend to buy gold out of Canada? Gold's a universal value, and so the price in Canadian dollars is kind of irrelevant. It shows what the Canadian dollar is doing versus gold. But the main question then you'd have to ask yourself is, do you think that the Canadian government is going to retrace what they've done and go back on what they've done and increase the value of the Canadian dollar? If so, and you think that's going to happen at a faster proportion then the demand for gold will go up. Then Canadian dollars would be a better hold than gold right now. But if you think that they're on a track that they're going to continue to do what they're doing, then gold will be a better hold right now than the Canadian dollar, even though priced in Canadian dollars, gold has gone up a lot already. Essentially, the world is in a race. The world's central banks are in a race to zero. They're trying to devalue their own currencies faster than everybody else without being accused of being a currency manipulator. And so it's a central bank game to see who can devalue their currency the most without, without the public catching on to what's going on. So I think compared to any fiat currency right now, gold is a good hold. You're new to buying physical gold. Is there a way to avoid losing 10 to 15% when you buy and sell coins? Wouldn't an ETF like GLD be better for that, since you lose less as compared to physical? I've already mentioned all of the pitfalls or the counterparty risks associated with buying gold through an ETF. When you look at the cost, the expense ratio, the annual expense ratio on GLD, I believe, is 0.5%. So if you hold your gold for 1 year and you buy physical gold and pay a 15% premium, that's a lot better than buying GLD and paying, sorry, not 1 year. If you hold it for, that would be 15%, that would be 30 years. So if you're holding your gold for the long term, your premium, the one-time premium that you pay, is going to be a lot better in the long run. Not even accounting for the counterparty risk. That annual expense ratio slowly degrades the value of that ETF. When that ETF GLD started off, it was a 10, was it a 10 to 1? Yeah, a 10 to 1 ratio, the share price to the ounce of gold, pretty much. And so right now, GLD is at about $150, whereas the spot price of physical gold is at about $1,600 an ounce. And so you can see that there's a slow decay in the value of an ETF because they have to take some off the top for fees. So you do pay a bunch up front when you buy physical. But then that begs the question, if physical is 10 to 15% higher right now for its premium, and it's probably a lot higher right now, to be honest. I've seen premiums a lot higher than 15% right now, just due to the supply crunch. So when you consider that the physical price of gold is up to almost $1,800 per ounce right now, what does that say about paper exposure to gold? Says that there's something wrong there. When you have the futures price of gold vastly different than the spot price of gold, and that is different than the physical price of gold, that shows that there are some red flags, and you need to be concerned. Right now, there are dealers that cannot locate physical gold. And so selling physical gold right now, there's American Eagles, 1 ounce American Eagles going on eBay for over $2,000 per ounce. And so the physical price of gold, yeah, you're going to pay a premium, but when you go to sell it, there's going to be a premium there as well. And so that's really the real physical price of gold right now, to be honest. When will silver go up? I don't know. It will at least go up with with the fall of the dollar. But right now, just like I said earlier, it's not, its monetary usefulness isn't there like it's always been with gold and still is with gold. I take it you are quite bearish on stocks. What if the Fed starts buying ETFs like they do in Japan? I'm bearish on stocks from the valuation perspective. They're way overvalued. They still are. Even after today's drop, even at the bottom, like a week ago when they bottomed out, they had just hit the point from a PE perspective, the S&P 500, that they were at the top of the bubble in 2008 from a valuation perspective. And so from a valuation perspective, yes, I'm very bearish. But from a price perspective in US dollars, like if you were going to come to me and you're going to say, hey, I have $100,000 in my savings account, should, and I'm gonna that it's either $100,000 in my savings account for 10 years, or even 5 years, or I put $100,000 in stocks right now, even just the S&P 500. I would absolutely, I would never hold that money in cash. So versus the dollar, yes, because the Fed is absolutely able to break the law and go against their congressional limitation and start buying ETFs that are equity based instead of, they're already buying ETFs that are broad-based bond ETFs. They can absolutely go further than that if, you know, the crisis gets bad enough and start buying equity ETFs. Further than that, if the price of a loaf of bread is $100 because of inflation, and you're willing to, you'd rather have a loaf of bread than 100 US dollars, how much more would you be willing to exchange one share of Apple for $5,000 or $2,500? The case for inflation is not values going up or prices going up. It's the value of the currency that it's measured in going down. And so if that starts to happen fast enough, people are not going to, they're going to be doing everything they can to get rid of dollars, especially if they can put it into assets. And especially around the world, central banks are much more likely to buy American assets rather than products. If they don't need the actual supplies. And so, yeah, we could see valuations in stocks go much higher. We could see prices of stocks go much higher, priced in US dollars, and that would just be a net result of the dollar collapsing. And like you mentioned, Japan does that, and it didn't help out too much there. Do I think any of the industries that are getting hammered, like airlines, restaurants, cruise lines, will at least begin to recover over the summer? Industries, sure. Companies, it depends. It depends on the speed and the effectiveness of the bailouts. And just like happened 12 years ago, Solyndra got a bunch of bailout money, got a bunch of stimulus money, got a bunch of free money from the government. They went bankrupt. AIG got a bunch of bailout money. They went bankrupt. And so just because you get free money from the government to take care of your current problems, that solves nothing, because those problems were there for a reason. And if you do not allow the free market to punish the behavior that caused the problem, the behavior will persist, and eventually it will repeat itself. And that's what we're seeing right now from 10, 12 years ago. And so, yeah, I think a lot of companies are going to go bankrupt from this. Eventually, even if they get bailed out right now and don't go bankrupt immediately. A lot of the industries, there's some industries that, like, so for restaurants, for instance, I think there's going to be a shift. It looks like there's going to be a big shift because a lot of money is flowing out of the small businesses that can't get their hands on a lot of the big free money. And so they're closing their doors, and all this commercial real estate is becoming super cheap. And so, you know, in the next year, 2 years, a lot of the big corporations that were able to get massive handouts from Uncle Sam, they're going to come in, buy up all this real estate for cheap, and they're going to spread their chains. And a lot of the stores, storefronts, local real estate that was occupied by small local businesses will be essentially transferred to the ownership of large companies that were able to get a lot of that Uncle Sam money. So as far as the time frame, again, we don't know. A lot of this depends on the government's response to the coronavirus and the severity of the coronavirus, whether there is going to be a second wave once we start seeing a large scale recovery. So who knows? If this is like the worst of it, then yeah, by the summer, we could see those industries start to recover from that perspective. But the credit bubble bursting and the kind of the snowball effect that has started from this kind of bubble getting popped, I think the cat's out of the bag already. So we're likely to have a really bad recession, if not depression already, regardless of what happens there. Do I expect a U.S. supply chain shock in the coming months due to China's limited production in the first quarter? What's my opinion of the impact of demand and supply shock at the same time? Covered a little bit of that already. one of the impacts is going to be the inflation numbers not reflecting reality for most people, because a lot of the demand goes away for wants, not necessities. So necessities get more expensive because there's the supply shock, but the demand can't go away. And the supply is restricted. I think we've already seen a lot of the supply shock. It looks like China's getting a lot of their factories back online. So it looks like we've already seen a lot of that supply shock play out. But in terms of what are the second and third and the effects that come after that from that, that's yet to be seen. We're seeing a lot. It's like we're seeing the Federal Reserve treat this like it's Hydra. You're cutting off one head and three more spring up in its place. So there are going to be massive unintended consequences that are going to spring up. One of those that was unexpected is mortgage companies that offer mortgages. They're experiencing a lot of volatility in their balance sheets right now. They're on the verge of collapse because of what the Federal Reserve is doing. They're buying mortgage-backed securities at such a quick pace that it's causing the insurance products that mortgage companies are using to hedge themselves to go haywire. So there are unintended consequences anytime you manipulate an economy and try and fix it. Other probably worse things are going to start to come up. So that's what I think we'll see. The supply chain shock is something that we've already seen and accounted for, and now we're going to start to deal with the consequences of trying to manipulate our way out of that. What's my opinion on Bitcoin? I have very little opinion on Bitcoin right now, specifically because I haven't studied it enough. There's a few opinions that I have of it that might be wrong. Like I said, I don't know enough about it. One of them is called the Lindy Effect. Lindy Effect is basically the longer something has been around, the longer it will be around. It's had more time to prove itself and to exist through more and more shocks, and it still exists and has survived. That means that it's robust against going away. Things like ideas, religions, practices, policies, and countries, ways of life, diets, and money is one of those. Gold being used as money has a minimum 3,000 year tradition behind it. So it's had a lot of time to go through a lot of tests that we're putting it through right now. What we're experiencing now is not unprecedented in terms of what is happening. There's been countless times throughout history where governments have debased their money, have issued paper currency, we're not seeing anything that hasn't been done before, and gold persists in its value. If you lived in Roman times, one gold coin, your salary in terms of gold, I can't remember the exact number of ounces of gold that Roman soldiers were paid, but it's an equivalent of about $70,000, $70,000 US today. And so the value of gold, when you put it in terms of pretty much anything that doesn't get cheaper from technology and efficiency, things like standard living wages and things like that, you're going to see the value of gold stays. With Bitcoin, it's so new. Who knows? Unbacked fiat currency has a longer history than Bitcoin. I like Bitcoin. I like the fact that it's woken up an entire generation to the deception of government and the problems with fiat currency and the manipulation of organizations like the Federal Reserve. So I like what it's doing. I like the fact that it allows a decentralized approach to payments. I don't see it has proved itself as a store of value yet. So yeah, that's my opinion on Bitcoin. Will it survive? No idea. Will it go up or down? No idea. But using it to transact, get around the banking system, sure, I like it. All right, according to the dollar milkshake theory, the US dollar will keep going up until there's something like a Plaza Accord 2.0. What do I think about that? And do I think the USD will keep going up before it collapses. Sure, maybe. The dollar milkshake theory is kind of funny. It's a short-term play against the longer-term trend. To me, if you're a top-down investor, you're going to look at, okay, what's the overall economy doing? Then what are the major indices doing? And then what are the industries doing? And then what is the company inside that industry doing? You make your decisions from a top-down perspective. From a top-down perspective, when I know that the long-term momentum and direction of fiat currencies is down, why would I bet on a short-term upwards play? Second, it's based on the fact that we're experiencing a dollar crunch, a dollar shortage globally. And the global dollar shortage theory ignores all of the foreign-owned dollar-denominated assets. In a dollar crunch, worst case scenario, foreigners own more dollar-denominated assets than the entire U.S. GDP. And so when you look at the dollar shortage, it's not all it's cracked up to be. And you're betting against the Federal Reserve's ability to print money. And that's something that I never like to bet against, because they've proven their resolve to print at an infinite, up to infinite levels and at faster and faster paces. And they've opened up every crisis level facility they have to get dollars out to the world. And so do we see a USD pop relative to other currencies? Sure. Ultimately, though, all fiat currencies are going down when you compare them against real assets. And so that's what I think of the dollar milkshake theory, those three things. Commercial market, I'm assuming you're talking about the commercial real estate market. You've been hearing that this is one of the asset bubbles, but when will we talk commercial? But when we talk commercial, what type are we talking about? Retail, food, malls, office, everything. Man, if there was a perfect storm for a bearish case on commercial real estate, it is now. Man, with the stay-at-home being enforced and work from home being encouraged by all these companies, with massive chains just stopping paying their rent because they don't have any customers. Like Cheesecake Factory just said, we're not going to pay right now. To the fact that that's widely spreading, but from malls, retail, food, yeah, everything. And the shift towards, for a long time, people have wanted to work from home. A lot of people do, unless you're an extreme extrovert. You don't have to deal with the commute. You can a lot of times then make your own hours. You're a lot of times more efficient. You don't have to deal with stupid meetings. They're just time sucks. You don't have to get stuck. You're probably hearing these words and thinking it sounds crazy from the, because if you're an extrovert, and you're hearing these things, it sounds like the rants and ravings of an introvert. But there are a lot of benefits from work from home that I think that this is going to set to affect new habits. And corporations are going to realize, why am I paying for all this office space? We're more productive as a workforce when everybody works from home. Everybody's happier, less sick time because people are less depressed from the 2-hour commutes per day. And people get to spend more time with their families, getting more flexibility. So just that, and that's only one factor. When you combine that with all of the other bubbles that are popping right now, commercial real estate is going to start to get hit hard. And the only thing that's going to save it or delay the inevitable collapse is going to be the Fed again sweeping in, buying up all the bad debt. Will failure in the Eurozone banking system cause a domino effect to the U.S. banking system? My concern is regarding the liquidity of their system seems to be more fragile. Yeah, that's why the Fed has opened up so many of these lines to get dollars out to these foreign central banks. It looks like the thinking is the Fed operates basically like the central bank, and so they're getting dollars out to all these other central banks as fast as possible, and then they'll rely on those central banks to deal with the crises in their own countries and produce all of their local currencies as they need. And so, could it cause a domino effect? Yeah, absolutely. It does seem like they're a lot more fragility and a lot more rot in their banking systems. So definitely. Let's say silver goes to hundreds. Who's going to buy it? And why would I trade it for dollars? If it costs you $100 for a loaf of bread, that means from inflation, that means that you'd rather have a loaf of bread than 100 US dollar bills. How much more would you rather have an ounce of silver for $200 or $300 at that point when you're comparing it to the relative price of everything else based in dollars? And so, yeah, and like I said, the monetary usefulness, it might not be there anymore. But it still has industrial use. It still has intrinsic value. It still has a cost of labor associated with it to produce it. And so you could have said the same thing back before in the 60s about the price of gold and silver. It would have been preposterous to say someday gold will be worth $1,600 an ounce. Let's see. Thank you, everybody, for saying that you love the podcast and the channel. Really appreciate it. When are they going to come up with world currency? I mean, we basically the world operates with the U.S. dollar as the world currency. It's the global reserve currency. So any commerce that's done in local currencies, when it gets at a macro scale, at a large scale globally, it is done with the dollar. But that'll probably be one of the consequences of everything collapsing right now. Is probably they'll try a new fiat currency, something like the euro, maybe, that is influenced and controlled by multiple countries. I don't know. We'll see. Oops. Are grains going up like the last crisis? I think logistics will be broken. Part of that depends on the how this public health crisis unfolds. We'll see. I don't think that's the main concern. I think the main concern is all of the stuff that we don't produce for ourselves. We've been relying on the world, relying on the dollar for us to get all of our stuff that we need. We're a consumer-based economy. We don't make any of our own stuff. So I think that's the biggest concern, is that when we have to start buying stuff from other countries with dollars that are worth a lot less, when the rest of the world doesn't want dollars, they'd rather have other things than US dollars. I think that's the bigger concern. And so logistics, yeah, I mean, we might be impacted, especially as we, try and move into, a more of a, when we have to start producing more for ourselves. What do I think about oil and investing in oil companies? I live in Alberta. Economy is pretty rough here. Unemployment was 8% before the coronavirus. Investing in oil companies, that's a tough one. There's a lot of oil, and Saudi Arabia and Russia right now are trying to prove that. They're trying to put everybody else out of business right now by flooding the market with supply, cutting prices, and trying to break some of the companies like in the U.S. that have survived off of free money, basically, and that have been over leveraged and exposed to a shock. And so investing in specific oil companies is a tough one right now. Oil at some point, yeah, I mean, especially compared to a fiat currency, eventually it'll go up. How much pain we'll see before then is anybody's guess, especially if there's multiple waves, this coronavirus, and international travel and local travel, everything is restricted a lot for a lot longer than some people are expecting. Yeah, it could get hit pretty hard. So individual companies, you'd probably, if you're going to do that, you'd probably want to find companies that are extremely well capitalized, have huge cash buffers to rely on, not a lot of debt, just really solid fundamentals. U.S. is going to take over central banks, maybe, unless all the central banks around the world have been fed up with the last 50 years of the United States using the dollar as a weapon, and they've used the last 5 years to build up a reserve, get prepared to de-dollarize. Then what leverage does the U.S. have over the rest of the world? I mean, sure, we could bomb them, but honestly, what leverage is that? Like, use our money or else we'll bomb you. I don't think that's going to happen. And And so when we don't produce anything, the only leverage we have right now is the US dollar and the fact that everybody is relying on it and using it. And when that goes away, what power do we have? What do I think about gold miner ETFs instead of buying physical gold, since you lose so much on trading physical? Again, you don't really lose so much because that premium is there because it's physical. And if you're selling physical gold right now, you're getting that premium. And so that's just the physical price of gold versus the paper price of gold, which there's a discrepancy there because there's something wrong. Usually that discrepancy is a lot lower. Mining stocks, they're not the same thing at all. Mining stocks versus physical gold or even gold ETFs, they're completely separate animals. They're not related. The only relation that they have is that when the price of gold goes up, then eventually the profits of mining stocks will go up, as long as they're good mining stocks. And so you have to treat it as if you're a stock investor at that point. You can't just base it on gold, because if you pick the wrong mining company that's relying on, they have tons of debt, or they're relying on getting new debt or rolling over their debt, or they're relying on exploration, or so if you're looking at mining companies, finding companies that are extremely well capitalized, large cash buffer zones, proven deposits, that's the way to play mining stocks right now. And ETFs don't really capture all that. They include a lot of garbage companies. And so that's part of the reason why the mining indexes have been hit recently, because there are a lot of garbage miners out there. Who do I listen to or read to get your source material? That's basically my, what I do for the majority of my my time in my day. I'm constantly reading books, listening to podcasts, reading blogs, following a ton of people. So a good answer to that, a short answer to that, is follow me on Twitter, go to my profile, click on who I'm following. And that's a very curated list of sources that put out, consistently high quality material on anything financial and anything economy and market related. And so, but yeah, and on Twitter, it's a little bit more focused. But when I'm doing my other research, like reading books and podcasts and blogs, I'm usually trying to do research with multiple sides and multiple opinions. That way, I'd rather find out that I'm wrong about something. That way I can adjust to it. Because if I'm wrong, why do I want to try and prove myself right? Essentially, this is to make money. So if I'm wrong, I want to find out so I can shift what I'm planning for to better capitalize on what's coming. So trying to get things from multiple angles. Can any of the large American banks go bankrupt during this virus crisis? In a free market, yeah, they're all insolvent, 100% of them. They're all going to be, they're just going to be absorbed by the Fed. All of their bad and toxic assets are just going to be absorbed by the Fed. So I don't think we'll actually see any actual bankruptcies from banks. I mean, we could. I don't think we will. Recent stimulus seems like universal benefit income, universal basic income versus previous stimulus created public works jobs to increase productivity. How this type of stimulus impact dollars purchasing power? The actual checks that people are getting are inconsequential to the spending that the government is doing. It's only $280 billion that was allocated to the checks that individual households are getting. The other, rest of the $1.7 trillion is going to just handouts, free money for all of the people who have their noses in the right places. But it's not allowing the market to devalue the bad assets. It's not allowing the destruction of the malinvestments to happen. It's absorbing that and swallowing that. And so the net result of that is inflation. When the market would try to have deflation and the manipulation comes in to force inflation, for monetary expansion to take the place of that, well, then you're going to have a lot more spending in a time that you'd have a lot less spending. And at that time, you're also having a massive decrease in production. So, yeah, it's not just the UBI checks. It's everything else on top of that. But yeah, I think the dollar's purchasing power that's going to be reflected in prices going up. Let's see, what's behind flooding the market with trillions of dollars? I mean, that's what it is. It's trying to soak up the bad assets. Number one, the bad assets from the credit markets, but number two, it's trying not, a lot of it is to buy up treasuries because the world is selling treasuries. And if treasuries get sold, that's bonds getting sold, that means yields go up. And if yields go up, the US government has short dated debt. And in order to pay that debt off, they just get new debt. But if rates go up, they can't get new debt because they can't afford that new debt. So the Federal Reserve is doing everything they can to put a floor under the selling of treasuries to keep the price of treasuries up so that the yield stays low, so the US government doesn't default, so that they can continue to roll over debt and get new debt. So that's what is behind flooding the market with trillions of dollars. Am I aligned with Ray Dalio's perspective on current situation? Ray Dalio is interesting because if you read between the lines, he sounds like an Austrian economist. If you read the actual words, he sounds like a Keynesian. For those of you who don't know what that means, he applauds central bankers and politicians for their intervention and their rescue policies, especially 12 years ago during the financial crisis and what the government did during the Great Depression. And he's studied the Great Depression a lot. But it's when you look at what he says are the inevitable consequences of that, he's really not saying anything different than somebody like Peter Schiff, who's saying it's all garbage what they're doing and they shouldn't be doing it. They're both saying the same outcome where monetary policy is ineffective. They're going to have to print more and more, and it's like pushing on a string. And he said cash is trash, and everybody piled on him for that because in that 1 month period, it would have been better to have cash and assets. But in the end, what he's saying is that it doesn't pay to hold cash, and so everybody's buying assets, and they're using debt to do so, and that's causing the problem to begin with. And so it's the system that he says that basically his perspective is the solutions that would be healthier are too painful short term, so it'll never happen. Yeah, I mean, maybe I'm interpreting a little bit too far, reading a little bit in between the lines too much, but that's what I think of Ray Dalio's thoughts and perspectives. Crazy to see supply demand changes. Oh, that's not a question. Thanks, David. I appreciate that. And let's see here. Will the Fed start buying equities? If they do, it'll be through ETFs first. I don't think they'll outright buy equities. Unless it's they're accepting they're accepting equity as collateral from banks. So essentially, the Fed's balance sheet, it blows up. They never wind it down. So when you talk about buying or accepting as collateral, the net effect is the same thing. They're swapping dollars for assets. It's the same thing as them buying them. The only difference is one has a promise it'll be unwound, the other doesn't, and the promise is never going to be fulfilled. So essentially, they're the same thing. Am I concerned about GLD tracking errors? Would I say physical gold is better? Yep. GLD tracking errors, largely that's due to the expense ratio degrading the value over time. It's also due to the fact that there's a physical supply shortage of gold right now. They say they have all the gold, and there's counterparty risk with that because their custodian is HSBC. And they store their gold in London. And it looks like London doesn't have as much gold as they say they do. What's going to happen with all of GLD's gold? Who knows? And so they probably have it. It's probably not, an enormous deal, but there are definitely layers of counterparty risk there. Is PHYS a much more secure gold ETF than GLD? I don't know. I've glanced through the prospectus of PHYS. I've dived into GLD's prospectus a lot more in depth. It looks like PHYS might have more exposure to unallocated accounts, actually, which could be worse because it looks like GLD does not have exposure to unallocated accounts. But ultimately, the general rule of thumb is if you don't have it, there's counterparty risk. And even if you do hold it, the risk is, somebody steals it or you lose it if you hide it in the wrong place or, accidentally throw it away. So there's risk there, but it's not counterparty risk then. That's just kind of your own risk. Is investing in real estate right now a good idea? Right now, there's no deals yet that I've seen. We're not seeing the same thing happen like 10, 12 years ago, because the government stepping in and saying, hey, we're not going to, government, local governments, federal government stepping in and saying, hey, we want to make sure people aren't getting kicked out of their houses, foreclosed on, banks are suspending mortgage payments. So we're not seeing values collapse right now. And so we're not seeing a lot of deals. That being said, any real asset goes up when you compare it against a currency that's collapsing. And so if you're saying, $300,000 cash versus a $300,000 house, especially if you borrow to buy that $300,000 house, you're probably going to be much better off to buy the house than sit on cash, because the value of the cash will go down and the price in dollars of the house will go up. And as the value of the currency gets destroyed, the pain it will take to pay back that debt will decrease. I don't know if you're going to be able to lock in I haven't checked in the last week whether banks are freely granting new mortgages right now. I don't think the credit markets have frozen up yet for buying new homes, especially residential, maybe investment. But it depends on what you're comparing it against. Values, they're overvalued. Compared in price to dollars, though, anything priced in dollars is going to go up. SD Bullion will sell you 100 gold eagles if you want them with 150 premium. Yeah, that's what I'm saying. That's the physical price of gold right now. Some of them are going to have larger premiums than others. Some of them will have higher minimum purchase amounts than others to compensate instead of having a higher premium. But that's the physical price of gold right now due to the supply shortage. And so that's why I said, like, if you have American Eagles, you can sell them on eBay. I've seen them going for over $2,000 an ounce. And so there's a premium on physical. That's the physical price of gold, which, again, the fact that there's such a big difference between the physical and the paper price of gold speaks that there's some problems with the system right now. What would it take to indict members of the Fed if they're caught technically breaking the law by purchasing unauthorized assets? What would that look like? Nothing. They don't do anything without, everything that they do is in tight coordination with the federal government. At this point, the two are so closely related. There's kind of a joke going around right now that the Treasury and the Fed basically just merged, putting Donald Trump as the Fed chair, the chair of the Fed right now. So they don't do anything really without coordination with the government. So if they're they are technically breaking the law. I don't think there's been a congressional amendment to what they're allowed to do, yet they're buying broad-based bond ETFs, to my knowledge. So cheers from Brazil. Your work is great. Thank you. Thank you, Rodrigo. I appreciate that. $250 premium if you credit card. Well, that's not the premium. That's a credit card processing. If you're buying money with money and the credit card processing company is charging 3%, they're not going to bite the bullet on that. They're going to charge that to you. So don't buy it with a credit card, because that's going to cost you 3% more. And that's not going to them. That's just Chase or Visa. That's that's American Express. That's the Discover. That's their fee for processing the credit. So the gold company is not going to eat that for you. You'd put 100,000 in the stock market right now. Isn't waiting for the market to drop further and then going bargain shopping a better strategy? It depends on what your time frame is and what you're comparing it against. If you say I've got 5 years, and in the next 5 years I'm going to make one choice right now and hold it for 5 years, 100,000 cash or 100,000 in the stock market, I'd never hold on to cash right now. With the amount that they're debasing the purchasing power of our currency, I'm not going to hold on to cash. If you're comparing that against $100,000 into gold versus the stock market, there's no way I'm touching stocks right now. If it's and what do you mean by the stock market? Are you talking Asian stocks? Because they have their values are great right now. There are a ton of Asian stocks that have great valuations. And I'm sorry, I know it's 10. I'll take a couple more minutes here to finish answering the rest of the questions that we have here. But if you have to go right now, I really appreciate you guys hanging in there, and hope I helped with these questions here. Really appreciate you guys. I'll answer the rest of the questions now. So yeah, Asian stocks, the valuations are great on some of them. and so they never reached a huge bubble. Some of these big bubble valuations, like some of the big large caps here in the States, did, because they weren't accessing obscene amounts of free money, basically directly from the Fed. Fed, prints money, gives it to the banks, and the banks have to loan it out for basically free. And then what are companies going to do with it? They're just going to take that free money, that interest-free debt, basically, and they're going to buy their own stock back, and they're going to get a great return on it. There's nothing wrong with a company deciding to do that. That's a smart use of their capital in the short term. The Fed shouldn't be providing all that free money to begin with. And then if they do that and they have to fail when the inevitable collapse happens, they should fail. They shouldn't get bailed out from that. But so it depends on what you're talking about, 100K into the stock market versus cash. And it also depends on the time frame. Like in the next month or two, yeah, we're probably going to see a big crash priced in US dollars. I've got puts on SPY right now. I think prices in dollars are going lower. That's a short-term play. I also have calls on the US on SPY, because I think that it is possible that we see a collapse in the dollar quickly, which would result in prices in US dollars going up, even in overvalued stocks, because I'd rather own an asset than a depreciating currency. Is there a reason to expect gold price to increase at a greater rate relative to other assets like agriculture, commodities, or stocks? Long term, the value of gold doesn't change. So appreciation in gold is going to be relative to what you're comparing it against, like the currency. So the gold price in terms of the US dollars increasing at a greater rate than assets like agriculture, commodities, or stocks. Yes, I think that's the case. Yes. Question, here in Brazil, the government isn't printing crazy amounts like the US yet, and our currency is already devalued 5-to-1 USD. You think it is still a good idea to buy some gold or silver? I am not too familiar with the Brazilian economy and what you guys are dependent on down there in terms of your imports, your exports, what your monetary policy looks like, what your government looks like in terms of their fiscal policy, how responsible they are with their finances, what the debt to GDP ratio is there. Those things are all going to matter. But essentially, take any paper currency that's ever existed, the long-term value is zero. The ones that still exist are on a pretty much a straight path to zero from the time that they began. So long-term play, when you're talking transactions, have any currency you want, doesn't matter. You use the local currency for your transactions, 1 month of expenses. When you're talking about savings, in terms of just preserving your purchasing power, not investing, when you're talking about savings, that's gold. It always has been. It's been gold. And then in terms of investing isn't gold. Investing isn't cash. Investing isn't saving or loaning. Investing is producing assets. And so in terms of your savings, gold is going to hold its value long term. Will they end up closing the markets, and if so, for how long? This is a good question. A lot of people are talking about it, and a lot of people want it to happen, and I don't think they will. And here's why. If you announce the market is closing in a week, what's going to happen? Everyone's going to sell. The market's going to just get crushed 50% one day. I mean, that can't happen because of the circuit breakers, but you know what I mean? Like everybody's going to sell. So they're not going to announce it in advance, number one. Number two, they're not going to do it just out of nowhere, because what's the next step? Well, people need cash. They're going to get a run on the banks, and people are going to go get cash from the banks. And that's where you have a lot of fear and a lot of the panic starting to happen, a lot of the the civil unrest, because banks don't have that much cash. They have the zeros and ones, the digital cash in the system, but you try and go get it, you can't. And so I don't think they're going to close the markets, because a lot of people are using that to live off of right now, especially a lot of the middle class that high income earners that are living paycheck to paycheck. It's a huge segment of our society. So I don't think they'll close the market just for that reason. It would create a lot more problems than it would solve. I think they'll just resort to artificially keeping prices elevated as much as they can before they close it. GDX is a gold stock index. I talked about gold mining stocks earlier. I prefer to pick individual stocks myself and rely on the index because there are just so many garbage mining companies out there. I'd rather pick them myself, pick a company that is well capitalized, sitting on a lot of cash, doesn't have a lot of debt, is not relying on getting new debt to continue their operations, and something that's sitting on a large proven deposit. From India here, I get important for gold in these times, but the importance of gold for these times, but our price of gold is done through the dollar. If the dollar crashes, do I lose all gains in gold as dollar may crash against local currency? Gold has universal value. And so whatever currency you're pricing it against, you can always price it against a different currency. And so if you are investing in gold and the price of the dollar collapses, then the price of gold in terms of the dollar goes up. Or I'm sorry, if the value of the dollar collapses, then the price of gold in terms of the dollar goes up. And so if the but even if that happens, technically in terms of the dollar, that's good for you. But you're never gonna, at that point, you're not gonna want to convert your gold back into dollars. Essentially, what saving your money in gold does is it allows you to bypass the devaluation of your purchasing power, and then you can move that purchasing power into any currency you want, and you've preserved how much purchasing power you have long term. And so you save your money in gold, you preserve your wealth in gold. It's not an investment, it's a wealth preservation tool. And then whenever you need currency to transact with, you're able to convert that into any other currency as you see fit. Is this a corona crash or a real recession, or even worse? You blow a bubble big enough, everything becomes a pin. The coronavirus happens to be a pretty large pin. At this point, with the early stages that we're in, it is unclear how devastating the public health crisis will be, at least here in the States. I know in some countries like Italy, it has been absolutely devastating. And then other countries like Singapore that handled it like champs, it's been, almost nothing has happened there. You would never see the Federal Reserve and the federal government resorting to this level of crisis intervention if it was not an all-out financial crisis and emergency. It's just not going to happen. Don't look at what they say, look at what they do. They've unrolled more emergency level programs and facilities in the last month than they did during the first year of the financial crisis 12 years ago. They've done, the pace at which the market is dropping is faster than any time in history. 1987, Black Monday, 2008, 2009, the Great Depression, where it's more volatile. There's no comparison. It's started to collapse the ultimate bubble that has been built up to unprecedented levels. The amount of rot in the system and corruption and piles of bad insolvent companies and bad debt are bigger than they've ever been. And it's due to the last 12 years of easy money policy trying to blow up the bubbles again. So the coronavirus is the catalyst, it's the trigger, and the avalanche is real. In a high inflation or hyperinflation situation, which assets are good to acquire? In that situation, everything goes up in terms of the currency you're measuring it against. And so that's why you see people panic buying in those situations. I'd rather have a loaf of bread that will maintain its value for 2 days than a dollar, which will lose, 10% of its 10 or 20 or 30% of its value over that same time. We've seen country after country after country in all throughout history. Same story. It's happened over and over and over and over again. It's a matter of when, not if, in our situation. You cannot violate the fundamental laws of money forever with no consequences. Eventually, you're going to have to face what is coming. And so in terms of what holds its purchasing power long term, doesn't change in value, gold. In terms of speculative assets that might appreciate a lot, maybe something like Bitcoin, something like mining stocks, you could have, see, 2, 3, 5, 10 times their price. And then in terms of investments, real assets that produce income. And so a lot of Asian stocks that have already bottomed out that produce, decent dividends. All the American stocks, they're plummeting right now and they're cutting their dividends. And so long-term investments right now, I'm not looking at US stocks right now. So, but in any case, when you see hyperinflation, you'd rather have anything other than that currency. And so everything essentially kind of becomes an asset at that point when you compare it against a currency like that. So, man, I really appreciate it, guys. We're about 10 minutes after the scheduled cutoff time here. Could I see one more question here? Could I see $1,000 S&P 500? Assume that means the 1,000 price, like the actual index hitting 1,000. Right now it's at 2,400. Yeah, I mean, when you look at previous crises, we have huge drops in the stock market. The Great Depression, I think it dropped like 80 or 86%. In the financial crisis, dropped to like 50%. And so at this point, I think we're down 27% as of the close market today. So yeah, if you're just comparing it against past bad crises and market drops, yeah, we could see 1,000 S&P 500. But we'll see what sort of manipulation rears its ugly head over the next couple weeks, a couple months. That is all. I really appreciate it, guys, and I hope I helped with these questions. Thanks for joining the live stream, and you guys have a great evening, and good luck investing, and I wish the best for you during these trying times. Stay safe, stay healthy.